America's debt didn't become a global problem overnight, and it didn't become dangerous because of one crisis, one president, or one bad decision. It became unavoidable because the entire world slowly learned to depend on it. Today, the number itself sounds abstract. Trillions upon trillions, figures so large they no longer feel real. But this debt is not just a domestic accounting issue. It sits at the center of global finance, trade, savings, and stability. Governments hold it, banks rely on it, pension funds depend on it, and markets treat it as the safest anchor in an uncertain world. This is the paradox. The most indebted country on earth also issues the asset everyone trusts the most. That contradiction is not accidental. It is the result of decades of financial evolution where safety, liquidity, and habit mattered more than balance. After World War II, the United States emerged not just as a military power, but as the financial core of the global system. The dollar became the reference point, and U.S. debt became the tool that allowed the world to store value, settle trade, and manage risk. Over time, what started as a national obligation transformed into a global necessity. Countries didn't just buy U.S. debt because they loved America. They bought it because there was no other market deep enough, liquid enough, or stable enough to absorb the world's savings. This is how dependence forms, not through force, but through convenience. As global trade expanded and capital flowed faster, U.S. debt became embedded in everyday financial plumbing. The system adapted around it. And once a system adapts, that's why every discussion about America's debt that ignores the global dimension misses the real story. The danger is not simply how large the debt is, but how many institutions would be destabilized if confidence in it ever changed. This is not a morality tale about overspending. It is a structural reality about how modern finance chose efficiency over resilience. And when efficiency dominates for too long, fragility builds quietly. The real question isn't whether America owes too much. It's why the world helped build a system where that debt became everyone's problem, and what happens when that assumption is finally tested. If America's debt became global because the system needed it, not because it was healthy, then what exactly made the world accept this risk? And at what point does dependence turn into danger? To understand why the world accepted America's debt so willingly, you first have to understand what U.S. debt actually represents in practice, not in political debates. When the U.S. government borrows money, it issues Treasury bonds, bills and notes, assets that promise repayment, backed not by gold or commodities, but by the credibility of the U.S. state and the dollar system itself. Over time, these treasuries evolved into something far more important than simple IOUs. They became the foundation of global finance. Banks use them as collateral, central banks store them as reserves, and financial institutions rely on them to manage risk and liquidity. In a world where money moves instantly across borders, what matters most is not who pays the highest return, but who can always be trusted to pay it all. U.S. debt earned that reputation gradually through scale, consistency, and system design. The American economy was large enough to absorb shocks. Its political system, despite chaos, maintained continuity. And its financial markets were deep enough to allow anyone to buy or sell treasuries at any moment. This combination created something rare, an asset that felt universally safe. As global trade expanded, countries needed somewhere to park surplus dollars earned from exports. U.S. debt filled that role perfectly. It paid interest, could be sold instantly, and was accepted everywhere. Over decades, this convenience hardened into dependence. Financial rules, risk models, and institutional mandates were written assuming U.S. Treasuries were the baseline of safety. This is why America's debt load grew without triggering immediate panic. The system itself demanded more of it. Every new regulation, every liquidity requirement, every crisis response increased the need for safe collateral, and U.S. debt was the easiest solution. But safety by assumption is different from safety by design. When the entire system treats one asset as risk-free, it stops questioning the conditions that made it so. That's when vulnerabilities begin to form, not suddenly, but silently. The more the world relies on U.S. debt as the anchor, the harder it becomes to imagine alternatives, and the more dangerous it becomes if confidence ever weakens. If U.S. debt became safe because the system needed it to be safe, not because it was inherently risk-free, then what happens when the conditions that created that trust begin to change? The global acceptance of America's debt cannot be separated from the historical moment that allowed it to grow without resistance. After World War II, much of the world was physically destroyed, financially exhausted, and desperate for stability. The United States emerged as the only major economy with intact infrastructure, productive capacity, and massive gold reserves. This imbalance laid the groundwork for a new financial order, one where the dollar became the center and U.S. debt became the mechanism through which reconstruction and trade could function. The Bretton Woods system formalized this role, tying global currencies to the dollar and the dollar to gold. Even after the gold link was severed in the 1970s, the habits and institutions built during that era did not disappear. They evolved. Oil trade, global banking, and international lending continued to rely on the dollar, reinforcing demand for U.S. assets. Each crisis strengthened this dependence rather than weakening it. When markets panicked, investors didn't flee the dollar, they ran toward it. This counterintuitive behavior allowed the United States to borrow more at moments when other countries were forced to tighten. Over decades, debt accumulation became normalized, not because it was harmless, but because the system absorbed it efficiently. The world needed a borrower of last resort, and America filled that role. This historical path matters because it explains why warnings about debt have been ignored for so long. The system was built to accommodate expansion, not restraint. Political cycles changed, but the financial structure remained. The result is a situation where past stability creates present vulnerability. The longer debt growth was rewarded with trust, the harder it became to question the trajectory. History shows that such arrangements persist until a shift forces reevaluation, not because logic demands it, but because necessity leaves no alternative. Understanding this historical inertia is essential to understanding why America's debt problem feels invisible until it suddenly doesn't. If history trained the world to trust U.S. debt through repeated crises and recoveries, what kind of event would be powerful enough to break that pattern of automatic confidence? What truly allowed America's debt to expand without immediate consequences was not just history, but the unique role of the U.S. dollar as the world's primary reserve currency. When a country borrows in its own currency, it operates under very different constraints than those that must borrow in foreign money. The United States issues debt in dollars, and the world demands dollars to trade, save, and stabilize their own systems. This creates a powerful feedback loop. As global demand for dollars increases, demand for U.S. debt rises alongside it. That demand suppresses borrowing costs and gives the United States extraordinary flexibility. Other nations facing similar debt levels would experience currency collapse or capital flight. America does not, because its liabilities are also the world's assets. This privilege, often called exorbitant but rarely fully understood, allows debt to grow without triggering the usual warning signals. But privilege creates distortion. When markets assume perpetual demand, discipline weakens. Political incentives shift from managing sustainability to managing appearances. Deficits become tools, not red flags. Over time, this reshapes behavior across the entire system. Global investors stop asking whether debt is growing too fast and instead ask whether there are enough treasuries to meet demand. That inversion is critical. It means the system prioritizes supply over prudence. The dollar's dominance also internationalizes the consequences of U.S. policy. Interest rate changes, fiscal decisions, and debt issuance ripple outward, affecting currencies, capital flows, and inflation worldwide. In effect, America's debt policy becomes global monetary policy by default. This is why escaping the system is so difficult. To reduce dependence on U.S. debt, the world would need an alternative asset with equal liquidity, trust, and scale. No such substitute currently exists, and until it does, the system continues. Strong on the surface, fragile underneath. The danger lies not in the size of the debt alone, but in the assumption that demand for it will remain endless. If the dollar's reserve status allows debt to grow without immediate limits, what happens when global demand begins to hesitate, even slightly, and how quickly can privilege turn into pressure? The real risk in America's debt story is not collapse, but complacency, the slow normalization of a system that only works as long as everyone believes it will. Over time, markets stopped treating U.S. debt as something to evaluate and started treating it as a law of nature. Rating downgrades barely move prices, debt ceiling crises become political theater, and record deficits are absorbed with a shrug. This indifference is not strength, it is saturation. When an asset becomes too central to question, the system loses its ability to adapt. Financial models assume treasuries will always be liquid, always be accepted, always be safe. Banks structure balance sheets around that assumption. Governments build reserves on it. Even rivals of the United States depend on it for stability. This creates a fragile equilibrium where the system appears stable precisely because no one can afford instability. The danger is that small cracks don't trigger alarms. They get ignored. Inflation spikes, fiscal discipline erodes, and political dysfunction increases. Yet the system continues because exiting would be more damaging than staying. That's how systemic risk accumulates, not through sudden shocks, but through deferred consequences. History shows that systems built on shared belief last until belief is tested, not debated. The moment trust shifts from unquestioned to conditional, dynamics change fast. Yields rise, borrowing costs increase, and feedback loops reverse. What once absorbed stress begins to amplify it. The irony is that America's debt became the world's problem because it worked too well for too long. Success removed urgency. And when urgency disappears, preparation follows. The question isn't whether U.S. debt will fail in a dramatic sense. It's whether the system has any graceful way to adjust if the assumptions underneath it begin to weaken. In global finance, resilience matters more than perfection. A system that cannot imagine alternatives is a system vulnerable to them appearing suddenly. That's why this story isn't about numbers. It's about belief, habit, and the cost of depending on something simply because it has always been there. If the biggest danger is complacency rather than collapse, then what early signs would reveal that global trust in U.S. debt is quietly shifting? And would anyone notice in time? When cracks begin to form in a system built on trust, they rarely appear where people expect them. The first warning signs of stress in America's debt won't look like default or chaos. They'll look like subtle shifts in behavior. Foreign central banks may slow their Treasury purchases, not selling aggressively, but quietly diversifying. Long-term bond yields may rise faster than short-term rates, signaling doubt about future stability rather than immediate panic. Political brinkmanship over budgets and debt ceilings may stop being dismissed as noise and start being priced into markets. These are not dramatic events, but in a trust-based system, small signals matter more than headlines. The global financial structure is sensitive to confidence, not catastrophe. Once participants begin hedging against uncertainty, liquidity thins and assumptions weaken. What makes this especially dangerous is that America's debt does not exist in isolation. It is woven into leverage, derivatives, and institutional mandates across the world. A slight repricing cascades through portfolios, forcing adjustments that amplify stress. This is how stability turns brittle. The system does not collapse because of one decision, but because flexibility was lost long before it was needed. At the same time, geopolitical shifts add pressure. Rival powers openly discuss reducing dollar dependence, while regional trade agreements experiment with alternative settlement mechanisms. None of these replace U.S. debt today, but they signal intent. Intent matters because it shapes expectations. The moment markets believe alternatives might emerge, the monopoly premium fades. Yet paradoxically, every attempt to move away from U.S. debt still runs through it first, reinforcing short-term dependence even as long-term trust erodes. This contradiction defines the current moment. The world wants optionality without disruption, but history shows transitions rarely stay orderly once momentum builds. The danger is not that America's debt loses relevance overnight, but that it loses, and gradual change is harder to manage because it offers no clear moment to respond. By the time the shift is obvious, positioning has already changed. In finance, reactions lag reality. That's why understanding early signals matters more than predicting crises. The system doesn't warn loudly, it whispers. If the earliest signs of danger are subtle and quiet, who is actually paying attention? And could the system already be adjusting before the public narrative catches up? One reason the system persists, despite visible strain, is that every major player is trapped by incentives that reward short-term stability over long-term change. Governments holding trillions in U.S. debt cannot afford a sudden decline in its value without harming their own balance sheets. Banks depend on treasuries to meet regulatory requirements and manage liquidity, making diversification risky rather than prudent. Even private investors, aware of structural weaknesses, continue buying because alternatives lack scale and safety. This creates a coordination problem. Everyone knows the system is imperfect, but no one can move first without absorbing disproportionate pain. In economics, this is how suboptimal equilibria survive. Not because they are ideal, but because breaking them is too costly. The United States benefits from this inertia, but it is also constrained by it. Fiscal expansion becomes easier than reform, while political incentives favor delay over discipline. The world's reliance on U.S. debt becomes both shield and burden. Shield, because demand remains strong, burden because expectations grow. The system begins to require continuous issuance to function smoothly, turning debt into infrastructure rather than liability. This reframing is dangerous. Infrastructure must be maintained, but debt must be serviced. When the two are conflated, accountability fades. Meanwhile, global demographics, slowing growth, and rising interest costs quietly erode the margin of error. What once felt sustainable under low rates becomes fragile when borrowing costs normalize. The system can absorb pressure for years until suddenly it cannot. History shows that financial transitions are rarely triggered by debt levels alone. They are triggered when confidence meets constraint. Constraint can be economic, political, or geopolitical, but once it binds, assumptions unravel quickly. The paradox is that the longer the system works, the harder it becomes to prepare for when it doesn't. The true vulnerability lies in rigidity. A system that cannot imagine alternatives cannot manage transitions. And transitions are inevitable, even if timelines remain uncertain. The question is not whether change comes, but whether it comes gradually through adaptation or abruptly through shock. If every major player knows the system is flawed but feels trapped inside it, what force could realistically break this equilibrium? And would that force come from markets, politics, or something unexpected? The most misunderstood aspect of America's debt is the idea that there will be a single clear breaking point, a moment when the system snaps and everyone suddenly realizes it went too far. In reality, global financial systems rarely fail in clean, dramatic ways. They drift, Pressure accumulates, margins thin, and resilience erodes long before any headline-worthy event occurs. For U.S. debt, the real danger zone is not default, but gradual loss of flexibility. As interest costs consume a larger share of government revenue, policy choices narrow. Spending becomes less about investment and more about maintenance. Each new shock, recession, war, financial instability, requires larger responses financed by even more borrowing. The system still functions, but at a higher baseline of fragility. Globally, this fragility spreads quietly. Countries that rely on dollar liquidity find themselves exposed to U.S. rate decisions they cannot control. Emerging markets feel tightening conditions first, then developed economies follow. Capital flows become more volatile and political pressure rises as economic trade-offs grow sharper. Yet the system persists because no alternative offers the same combination of scale, trust, and immediacy. This creates a dangerous illusion that persistence equals sustainability. History warns against this assumption. Many dominant systems lasted far longer than critics expected, only to change rapidly once constraints became binding. What accelerates such shifts is not debt itself, but the interaction between debt and trust. As long as trust absorbs stress, the system bends. When trust becomes conditional, stress multiplies. The challenge is that trust rarely announces its decline. It fades through behavior, not declarations. Slightly higher risk premiums, quieter diversification, more frequent policy interventions. These are not alarms, but symptoms. By the time they are widely recognized, adaptation becomes harder. The uncomfortable truth is that America's debt became global, not because it was perfect, but because it was convenient. And convenient systems tend to endure until they don't, then change faster than expected. Preparing for that possibility requires imagination, not panic. But imagination is precisely what rigid systems lack. That is why this story matters, not as a prediction of collapse, but as a warning about dependence, incentives, and the cost of postponing adjustment. If global systems don't break suddenly but drift into constraint, how would anyone recognize the moment when adjustment is no longer optional? And are we closer to that moment than it appears? At this stage, the most important question is not whether the system will change, but how the adjustment might unfold without breaking everything attached to it. Because any meaningful shift away from America's debt cannot be clean or isolated. It would reshape trade, savings, currencies, and political power all at once. This is why policymakers speak carefully and act slowly. Even acknowledging the problem too directly risks undermining confidence. So instead of radical reform, the system leans toward incremental adaptation. You see this in subtle ways. Discussions about local currency trade settlements, modest increases in gold reserves, regional financial arrangements, and cautious experimentation with digital currencies. None of these replace U.S. debt today, but they reduce marginal dependence over time. This is how transitions actually begin, not with declarations, but with hedges. The danger is that hedging itself can accelerate change once it reaches critical mass. When enough actors quietly prepare for a different future, the present system loses its monopoly on expectations. That's when feedback loops reverse. What once stabilized markets begins to amplify volatility. For the United States, managing this transition is uniquely difficult. Tightening fiscal discipline too aggressively risks recession and global instability. Ignoring debt dynamics risks long-term erosion of trust. Every option carries cost, and delay remains politically attractive. Globally, coordination is even harder. No single country wants to lead a shift that could devalue its own reserves or disrupt trade. This mutual hesitation prolongs the status quo, but also concentrates risk. History suggests that when systems reach this stage, change usually comes from an external shock rather than deliberate planning. A crisis forces decisions that gradualism avoided. The tragedy is that most of the damage happens not because solutions are unknown, but because incentives discourage early action. America's debt became the world's problem because it solved too many short-term needs too efficiently. Now the challenge is finding a path forward that reduces dependence without triggering the very instability everyone fears. That balance between adjustment and disruption is the hardest problem in global finance, and it is unresolved. What matters now is not predicting a date or number, but understanding the structure well enough to recognize when adaptation turns into necessity, because by then, the choices narrow fast. If slow adaptation is already happening beneath the surface, what would a final external shock look like? And would it force reform or accelerate a disorderly transition instead? The uncomfortable truth is that there is no dramatic ending to America's debt story, only slow consequences shaped by preparation or denial. The United States will not suddenly default. The world will not wake up one day and abandon U.S. debt overnight. What changes instead is the margin for error. As interest costs rise, demographics shift, and global trust fragments, the system becomes less forgiving. Small policy mistakes carry larger consequences, and options that once felt manageable become politically and financially constrained. This is how global financial dominance weakens, not through collapse, but through pressure. America will likely remain central to the global system for years, but centrality does not mean immunity. Financial power is ultimately built on confidence, and confidence depends on credibility over time. The world accepted expanding U.S. debt because the dollar system delivered stability, liquidity, and predictability. The moment that trade-off feels less favorable, behavior adjusts quietly at first, then collectively. That adjustment is already visible beneath the surface. If you want to understand why the dollar still appears strong today despite these deep structural risks, you should watch our previous video titled Why the US Dollar is Rallying. But the weakness underneath could trigger a bigger shift in 2026. That video explains the surface strength that makes this debt system feel safe, and together these two videos reveal both sides of the same global story. If you found this analysis valuable, subscribe to the channel, like the video, and share it with someone who follows global finance, and comment below, do you believe the world can slowly reduce its dependence on US debt, or will real change only come after a shock forces it? Because how this question is answered will shape the next era of global power, and ignoring it won't stop the transition when it finally arrives. If every dominant financial system in history eventually faced a moment when confidence met constraint, what makes us think this one can escape that fate? And are we closer to that moment than most people realize?